So we are G for mutual fund investments. We are lucky that we have a speaker amongst us who has experience in this area. We have Mr. Amit Grover with us. So Mr. Amit is a mechanical engineer and also an MBA graduate, and he has over 16 years of experience in financial services industry. He also specializes in wealth management and training people to invest in the mutual funds. He's also a CFA level 3 candidate in his most recent positions. He has served as head of learning and development for funds like IDFC mutual funds and DSP mutual funds. He has in his career he has done over 1200 training sessions for all the people who want to learn about the dynamics of investments. So let's welcome our speaker.
Thank you, Vikram. Absolutely happy and excited to talk to your audience.
So basically, yes, we are excited to have you. We are excited to have you as well.
Thank you, Vikram. So basically, we're talking about money. We're talking about personal finance, a very interesting subject. And the irony is that it's a most important topic, a most important subject. But the irony is that this subject was never taught to us. So Vikram, if I ask you, if you look at your school curriculum, you are taught physics, math, science, possible everything. Today's kids are even learning computers, programming, coding, and everything. But this important subject, which is called as money, personal finance, investing, was completely missing. Leave about schools, even when you did your graduation or when you did your post-graduation, okay, you are taught possibly everything around the world. But this important subject, which is called money, personal finance, investments, and taxes, was completely missing. And that's the reason, predominantly, you, me, a lot of us have got zero idea about this subject, which is called as personal finance, investments, and money. In the next 20-25 minutes, I'll try to simplify the subject as much as possible and explain you the role of mutual funds, how by using mutual funds, you can actually achieve all your goals in a very systematic and a logical way. So let me start by first sharing my screen.
Sure.
So the topic is perfect strategy for mutual fund investments. Okay, so let's start with a very basic thought. What I understand is that most of my audience right now who is listening, they are just out of college. They have got job and they're trying to figure out how to manage money and how to manage the uncertainty about investments. The first thing is, okay, the moment you pass out, the biggest challenge which you guys face, okay, which fortunately, which to an extent I didn't face when I passed out, is the problem of plenty. Too many options makes anyone absolutely anxious. In fact, if I look back at my life, there was only one mobile phone. There were very few options in possible everythings. So decision making was simple. Today in your life, there are plethora of options, and that's the reason why technically many times we get too anxious about it. So let's start with a very basic thought. Why do we have to save and invest? And to understand this, let's try to understand three basic things. First is inflation. Okay, I know it's a very basic concept, but let me take some time to explain you what is inflation. My son is in class 5th. He's just starting his class 6th. His annual fees is approximately 1 lakh rupee. If I look back at my life, I did my entire engineering in 1 lakh rupee. So basically my son's 1-year fees is equal to my entire engineering fees. And this in simple terms is called as inflation. Inflation or Mengai was there, is there, and will always be there. So the first reason why we all of us have to save and invest, because we have to defeat this invisible enemy, which is called as inflation. That's first. Second thing, what is happening in life is that our standard of living is increasing. Okay, over a period of time, our standard of living is increasing. And the interesting thing about standard of living is that you cannot take a reverse gear. Once you get used to a particular standard of living, you cannot go back. For example, you have a particular mobile speed. If I say, you know what, can you go to an era where the speed was less? No, you will say, I've got used to it. And that's what will happen in lifestyle, in life also. As your standard of living is increasing, you will have to maintain that. And that's the reason why you'll have to save and invest. It's called standard of living inflation, which is there. And the third part is nexting. What is nexting? Basically, as human beings, we think, okay, you know what, when I graduated, I thought, you know what, if I have a Maruti 800 car, my life is sorted. Then I thought, you know what, when I had the Maruti 800 car, then I thought, you know what, I want a Zen. And then over a period of time, my desires kept on changing. Thing is, our lifestyle will also keep on changing. and our desires for new things will keep on erupting. We'll also have to plan of our goals, which we will have 10 years, 15 years, 20 years, 30 years down the line. So let's start with basically how do you plan? Okay. Obviously, as human beings, we dream a lot and we have got a lot of visual thinking. But financial goals is not about visual thinking. It's about reality. And how do you start that? So basically, in our mind, we have got many goals. Okay. And then there are bucket lists and then there are dreams. And everything is there in our brain. So first thing is take a simple piece of paper and write down your short-term goals, your medium-term goals, and your long-term goals. When I was your age, around 20, money for marriage, I needed some money for my travel after marriage. That was my short-term goal. My medium-term goal was buying a car. And I had basically two long-term goals. First was my retirement. And obviously, when I got married, my another long-term goal when I had a child was my son's higher education. So first thing is you have to write down your goals, your short-term goals, your medium-term goals, and your long-term goals. Okay. And when you're writing down your goals, you have to be very precise about it. You cannot write visual thinking over there that I want to travel across the world. If it's vacation, you need to define where exactly you have to go and how much money you would require and when you want to go. This is what we mean by writing down your goals. Once you have written down your goals and you have written approximate amount which you will require to achieve these goals, then we try to figure out how mutual funds can actually help you achieve it. Basically, these are some of the bigger goals which you will have to spend in life, okay, which you'll have to save and invest in life. You might have to buy a house. You will have to maintain a standard of living. You might buy a car or you might buy a two-wheeler. You would like to go for many vacations. You would like to fund your children's marriage. And last but not the least, but the most important thing is retirement. I don't know whether it's a good thing or a bad thing. Most of us will live very long. We might live till the age of 80, 85, and even 90. And most of us actually are working in service industry. In service industry, technically, our life, our working life technically gets over at the age of 50, 55. Now imagine you'll have good 20, 25, 30 years of zero income life. So basically, when you are planning, always think about retirement. And when I talk about retirement, generally, when I talk to retirement about somebody who's young, he says, you know what, I've just started earning money. Why am I even thinking about retirement? To explain this, let me take a very basic thought. Retirement doesn't mean that you have to stop working. Retirement means basically building up a corpus which gives you a lot of freedom in life. Okay, when you have a decent corpus in life, it gives you a lot of freedom. You can choose to work in companies which you like. You can choose to work with people whom you like. You can take breaks in between. If in case you're not feeling good about life, you're not feeling good about work, you can take breaks in between. You can basically even tailor make your life based on what your aspirations are. So retirement doesn't mean that you have to stop working. Retirement doesn't mean that basically you have to just save as much as you can and then you don't work. It's not about that. Retirement corpus means it gives you a lot of options in life. This is what we mean by retirement. So basically these are goals which are real goals, and one needs to plan about these goals, and that's how you will achieve your goals. Now, obviously, life is also not linear. Okay, you have just got a job, you're doing well, or maybe you have started your business, you're doing well. Okay, life is not a straight line. Life has got ups and downs. There'll be good times in life, there'll be bad times in life, there'll be horrible times in life. So always also keep some money, okay, about for uncertainty. Have a health insurance because you can always fall sick. Have a life insurance, especially a term insurance. Okay, a term insurance is something, if in case something happens to you, your nominees or somebody who are financially dependent on you, like maybe your wife or maybe your parents over a period of time, they will get a financial corpus. Okay, have a life insurance, have a health insurance, and also have some money for emergency. एक हिंदी की कहावत है, अच्छा वक्त बता के नहीं आता, बुरा वक्त बिल्कुल बता के नहीं आता. Keep some money for emergency. It's like having a stepney in the car, okay, for those uncertain moments. Now let's try to figure out how technically mutual funds will help you achieve these goals. So what I've done is basically mutual funds, I've put them into two categories, two asset classes. First is equity. Second is fixed income. I'll explain both of them. And then there is a category which is called hybrids. It's not an asset class. Hybrid in a simple way is a combination of equity and fixed income, which I'll explain it later. But let's talk about the first asset class, which is called as equity. what is equity in a very simple terms, and I'll try to simplify and dumb it down so that you understand it. Basically, equity means investing into businesses, as simple as that. And when I say investing into businesses, all these businesses, basically you use them on a daily basis. I'm sure when you get up in the morning, you brush your teeth, you're either using Pepsodent or a Colgate listed companies. Or when you paint your wall, it's Asian Paint, Nerolac, Berger Paint, listed companies. You have tiles at home, Kajaria, listed company. You have light, Havells, listed companies. You fall sick, Cipla, Dr. Reddy's, Ipca Laboratories, all these are pharma companies or listed companies out there. I'm doing this session right now on an Airtel Broadband, a listed company. When you buy a car, Maruti, Mahindra, Tata Motors, or you take a two-wheeler, Bajaj, TVS, Hero, all of them are listed companies. I'm just naming these companies just as example. These are not stock recommendation. Basically, there are many companies which are listed in our country. Okay, what is equity? Equity means investing into these companies. As these companies grow over a longer period of time, even your money will grow. If you look at the history of last 42 years, okay, Sensex is nothing but the top 30 companies of the country. It started back in 1979, okay, which is approximately 43 years back. If you do a simple maths, in 1979, approximately the index was 100. As we speak right now, it's approximately equal to 60,000. That means a 1 lakh rupee invested back in 1979, the value today is approximately 6 crores. Yes, you actually heard it right. A 1 lakh rupee invested 43 years back in Sensex, just a broad-based Sensex, the value today is approximately 6 crores. That's the power of equity to create wealth over a longer period of time. But this journey in the last 42 years was not a straight line. It was not like that from 100 to 60,000, it was a straight line. In this entire journey, there were many ups and downs. There were good times, there were bad times, there were horrible times, there were crazy times, there were elections, there was anything and everything bad and good you can think, everything happened in the entire journey. So what is equity? Equity means investing into businesses. Now, couple of things which you have to understand about stocks and businesses. First, businesses have a potential to create returns. What happens when you diversify your money across various stocks and various sectors? Your risk comes down. Then you might have a second fundamental question that, you know what, there are so many companies and it's so technical. I don't understand that. How do I find good companies? Can somebody do it for me? And this is where mutual funds come into picture. Like I belong to HDFC Mutual Fund, one of the largest AMC asset management companies in the country. So basically people like you, people like me, thousands, lakhs, crores of investors across the country, they pool in money and they give it to a mutual fund. And now what is a mutual fund? Basically, there's a mutual fund manager and he has a team of analysts. Analysts are typically who look and analyze every sector. So like at HDFC Mutual Fund, we have got a pharma analyst, a telecom analyst, a banking analyst, infrastructure analyst. So we have got various analysts who analyze every sectors and they work together with a fund manager. A fund manager is the one who manages all the money and diversifies the money in well-researched stocks. Which kind of mutual funds are available in the market? I'll give you a glimpse of that. There are mutual funds which are called large cap mutual funds. They invest into large cap companies. Typically, the top 100 companies of the country are called as large cap. Then there are mid cap funds. Mid cap funds are typically those funds where a fund manager invests into mid cap companies. Just to give you an example, from 101st stock to 250th stock, those 150 stocks are called mid cap. Fund manager tries to find good stocks among that mid caps and invest into mid cap stocks. Small cap basically is from 251st stock to the 500 stock. Okay, these are small companies. The beauty of small cap is that small companies have a potential to do well, but small cap companies also have a lot of ups and downs, high volatility. So there are large cap funds, mid cap funds, and small cap funds. Then there is a category called as flexi cap or a multi cap fund. This is my favorite category. And if in case you're starting mutual funds, SIP or lump sums, this is first category which you have to look at because it's a very amazing category. It has a combination of large cap, mid cap, and small cap. So one fund, basically you get all the three categories in one fund. That's the best way of doing it. Multi-caps are also quite similar. You have large cap, mid cap, and small cap, all three categories into one fund. Then there are focus funds. Typically, focus fund have concentrated portfolio. They need to have at least 30%. They need to have at least 30 stocks in their portfolio. Okay, maximum of 30 stocks in their portfolio. Okay, so it's a concentrated portfolio. You can also use equity mutual funds for tax saving. It's called ELSS, Equity Linked Savings Scheme. They have a 3-year lock-in into it. So what happens is that your money is locked in for 3 years. It's like a typical equity mutual funds have a diversified portfolio. It helps you create returns from a long-term perspective, and at the same time, it gives you tax benefit under Section 80C. These are active funds. What are active funds predominantly? Where there's a fund manager and there are analysts, and then they try to outperform the market. And then there are pure passive funds. And what are passive funds? Passive funds are basically those funds which do a simple cut, copy, paste of the benchmark. Just to explain you the most famous passive funds in our country, there is basically a Nifty 50 fund. Like in HDFC, we have got a HDFC Nifty 50 fund. It just cut, copies, paste of stocks which are just constituents of Nifty 50. So exact same weights which is there in Nifty 50, it will buy that. We also have got a HDFC Sensex fund. It takes basically those 30 stocks which are there in the Sensex. Exact same weights of Sensex are available over there. The advantage of a passive fund is that the expense ratio in a passive fund is very low, but there is an advantage and disadvantage. The advantage is that you will get the market returns. The disadvantage is that you will not be able to outperform the market. In active funds, obviously, there's no guarantee that they will do it. But if you look at past data, a lot of them have done a decent good job of outperforming the market. So as a first-time investor, maybe you can start with passive funds, or maybe you can start with active funds, or maybe you can have a combination of both of them. These are basically called equity funds. I hope you understood the journey of equity market. Just to explain to you the kind of returns what you can make in an equity fund. In HDFC, we have got a HDFC Flexi Cap fund, started back 28, 29 years back. Obviously, it started with the NAV of 10. As we speak right now, the NAV is more than 1,000. That means in these 28, 29 years, the NAV has moved from 100 and now it's more than 1,000. That means the money has got multiplied 100 times. That is the power of equity mutual funds to create wealth over a period of time. Obviously, I'm not trying to extrapolate returns. Past performance is not a guarantee of the future, but it just gives you a glimpse in terms of the potential of what equity and equity mutual funds can deliver over a period of time. But that's only returns. I'll also explain you the risk. There are many times where market gives no returns. They can be long periods, like for 4 years, 5 years, 6 years, equity markets can give you no returns. Just to give you an example, 2008 to 2014, for 6 years, equity market gave no returns. So yes, there will be periods where equity market will give no returns. There will be periods where markets will correct a lot, like in 2008 global financial crisis, the large cap funds or Nifty corrected more than 50% in 1 year. During the time of COVID in March 2020, markets corrected by 36% in just 20 days. So yes, you will have to go through ups and downs. The returns of equity market are not free. They are full of ups and downs. So is equity mutual fund risky? Yes, it's absolutely risky if you're investing for a very short period of time. But if you are investing for a long period of time, let's say 7 years, 10 years, 15 years, 20 years, 30 years, the risk keeps on reducing, because over a longer period of time, equity mutual funds, equity gives good returns. But over a shorter period of time, obviously markets can go up and down. So it's very difficult to say. So basically, if you are investing into equity as an asset class, your investment horizon has to be at least 7 years plus. I would be very happy at your age. Okay, ideally, if you are around 20, 25, 30, you should think about 25, 30 years as a time horizon. And that's how you will create amazing wealth over a period of time. Now, let me talk about the second asset class, which is called as fixed income. Basically, fixed income means you are basically investing into bonds. So what are bonds? Basically, bonds are something where government borrows money or corporates borrow money. You are giving money to them and you get interest. Okay, bonds have tenure. So shorter tenure funds are called money market funds. So to park your money, you can use money. You can use funds like liquid funds or ultra short-term funds or low duration funds. So So for example, if you need, if you're going for a vacation after 1 year, you should rather put your money into a liquid fund or an ultra short-term fund. Okay, let's say you have to go for a vacation after 1 year. Just to give you a hypothetical example, let's say you have to go to Bali and you are planning that, you know what, after 1 year I have to go to Bali, and the approximate cost might be like, let's say 1.5 lakh rupees, and you've got 1 year. You can do a simple maths, 1.5 lakh rupees. So let's say you invest 12,000 rupees per month in a liquid fund or an ultra short-term fund. Over a period of 12 months, you can actually save that money using an ultra short-term fund and use that money going and fund your trip. Similarly, we have short-term funds. They can be a good replacement for a fixed deposit. Okay, these are basically funds where you can invest. They're not replacement for a fixed deposit. Fixed deposit, the interest is guaranteed. Okay, it's quite predictable. In short-term funds, there is some amount of volatility, so you'll have to understand typically how short-term funds work. But they have a potential to give you better returns. They have a potential to give possible better returns than fixed deposits. So you have to study these funds. Then there are interesting funds which are called as hybrid funds, especially if you're a first-time investor and you feel too anxious about markets going up and down, but you still want to invest in equity, then you can start with hybrid funds. So hybrid funds are basically combo funds. First interesting hybrid category is a multi-asset fund. It has equity, debt, and gold, all three asset classes. Then there are aggressive hybrid fund. It has got equity and it has got some portion into debt funds, or which are called fixed income. And then there are balance advantage fund. Interesting category. It has got equity and fixed income. The portion of equity keeps on changing based on market valuation. So when markets are cheap, the fund increases equity allocation. When markets are expensive, it reduces equity allocation. Just to give you an example of HDFC balance advantage fund, like during the time of COVID, we increased the equity allocation to 80-85%. And now as we speak, we have reduced the equity allocation to around 60%. So based on market valuation, we keep on changing the equity allocation. That is basically called as balance advantage fund category. So basically, that's a sum of basically what mutual funds are. Mutual funds are basically pool investments. There are equity mutual funds, there are fixed income mutual funds, there are hybrid funds. Now, obviously, you have a lot of questions to ask. How much to invest? Is SIP better or lump sum better? What are the big money mistakes? What is the right asset allocation? What is diversification? How to pick up the right fund? How to calculate returns? How to avoid taxes? And how to plan for retirement? I will take all these questions in the chat box, and I'll try to answer all the questions that you are asking. So Vikram, if in case you can see any questions from your audience,
I have few questions from my side. Maybe I'll finish those things first, then we can take up a question from the audience.
Yes.
So first of all, thank you for those lovely insights regarding the mutual funds. We got to know in depth how a fund is managed by fund manager, how a fund is allocated. I mean, how many companies, where do they invest and how do they invest? What are the regulations they need to follow on those things? So my question would be, so there are two funds, right? Open-ended fund and closed-ended fund. So what's the difference between these two?
See, in equity mutual funds, majority of the funds today are open-ended. Okay, in equity mutual fund, majority of them. Okay, or I would say practically all of them are today open-ended fund. Okay, what is an open-ended fund? You can enter anytime and you can basically exit anytime. Okay, that's the biggest advantage of equity mutual funds or mutual funds in general. You can enter anytime and you can exit anytime. Okay, that's what is called as liquidity, which is very difficult to do for other asset classes. In real estate, just an example, you cannot sell your balcony or kitchen if you need money, right? Yeah. But in mutual funds, you can redeem partially, you can redeem the entire amount. So basically, it gives you a lot of flexibility. So these are called open-ended funds. There are closed-ended funds, which were earlier, a lot of funds were there in the market which were closed-ended. So closed-ended basically had a lock-in. There were three years closed-ended, 5 years closed-ended. So basically, it had a start date, and the money matured after the period. Okay, when it got over. They were there earlier, but today majority of the funds are open-ended. There is only one fund which has a lock-in, which is called as an ELSS fund. It has a 3-year lock-in because it is a tax benefit which is you are getting under Section 80C. In fact, this is the only instrument for saving taxes which has got the lowest lock-in period. The second option, let's say you put your money into life insurance or a ULIP plans or endowment plans. The periods are like 5 years, 10 years, 15 years lock-in. A PPF has got a 15 years lock-in. In this, the money is just locked in for 3 years.
So my next question would be, sir, you told there are three categories of mutual fund. One is equity based, debt based, and hybrid based. So how do the returns vary across these three segments? Given that, I mean, I'm going with this, the returns in equity funds should be the highest, right? So
Right.
yeah, if you can put some light on that question.
Sounds perfect. See, what is the objective of all three? I would not say hybrid is an asset class. Hybrid is basically mixing two assets.
Mixing also.
There are two assets, equity and fixed income. I'll just define equity for you. Equity has a potential to beat inflation over a period of time. Okay, so and this is what we mean by wealth creation. Because at the end of the day, what is the job of an asset? It has to beat inflation. So equity has a potential to do it. Fixed income by nature, if you look at long-term returns of fixed income, the nature of fixed income is to preserve your money. So it doesn't give you much ups and downs, but it gives you returns in line with inflation. So if you look at your long-term wealth creation, okay, when you look at your money in fixed income, yes, your money will grow, but will it be able to beat inflation? Answer is difficult. It's difficult for fixed income to do it. It might match it, but it's very difficult for fixed income to beat inflation. But equity has a potential to beat inflation over a longer period of time. And this is what history shows us. And that's the beauty of this asset class. You have to create wealth because you need to have assets which can beat inflation. I started my presentation explaining how inflation is the biggest enemy which we all are basically fighting for. Okay. And I'm not saying that you should put all your money into equity. Okay. You have to decide based on your goals. So just to give you an example, Vikram, let's say if I was you at your place, if I realize my short-term goal is maybe, let's say, getting married, I would not put that money into equity because I know it's a short-term goal. Okay. And what if market falls? I cannot postpone my marriage, right? Okay. That's a short-term goal which is there. So obviously that money you will put into something which is called safe, which is fixed income. Maybe you'll put this money into a fixed deposit, or the better option is you can put this money into a fixed income. Okay. And you can invest on a monthly basis, like in a form of SIP in fixed income for your short-term goals. I'm sure after marriage, you would like to go for a honeymoon. That money also you would like to put in fixed income because you would not like to tell your wife, you know what, sorry, the markets are down. We
Of
have to
course, we will
cancel our
not
honeymoon.
do.
You'll not do that, right? So basically, you would like to put that money into a fixed income. But on the other hand, let's say if you are planning for your for your retirement, okay, you are thinking about long term, like 15, 20, 25, 30 years. You would not like to put that money in something which is very safe because after 20 years, when you look at that money, it would have not grown much. It was just barely beaten fixed income or the inflation. In that case, you would like to put your money into assets which can grow. So maybe that money you would like to put this into an equity mutual fund. Okay, I told you as a starting point, look at flexi cap fund or a multi cap fund. Amazing ideas. You have a combination of large, mid, and small, and then you would do long-term SIPs. Okay, let's say if you're just starting and no amount, trust me, is small. You can start with as small as 500 rupees SIP, 1,000 rupees SIP, a 2,000 rupees SIP. I remember when I started my SIP in 2006, it was 2,500 rupees. Fine, no problem. As your salary would increase over a period of time, keep on increasing your SIP amount. It's as simple as that. And the beauty is that SIP is extremely flexible. If your salary increases, you can increase your SIP amount. If in case some challenges are there, you can pause your SIP, you can reduce your SIP. Absolute flexibility is there. So for long-term goals, which I would say like 10 years plus or 15 years plus, put into equity mutual funds. For short-term goals like 1 year, 2 year, 3 year, 5 year, put this money into fixed income mutual funds and use SIP and lump sum as a tool to achieve these goals.
Yeah. So having said that, would it be right to say the fixed income mutual funds are less riskier, but they're not completely risk free? But I mean, in the way they're directly related to the interest rate which is prevailing in the country, right?
Absolutely.
We know what's happening in the US. It was the interest rate was around 1% in 2020. Now it's gone up to 6%, I think. So it has affected the bond markets to a greater extent. So in
So
that
Vikram,
way, even they're
you are
not
right.
even.
But if you look at why the interest rates were low, because the inflation at that time was low. Today, interest rates are high because the inflation is high. So if you look at returns net of inflation, it's fixed income is trying to give you returns which are in line with inflation.
Yeah.
Okay, so basically the objective of fixed income is to. So if you look at the era, okay, if you look at the era of 2012, 2013, interest rates in our country was around 10% because inflation was very high. Then there was the era when interest rates were very low because inflation was very low. So fixed income will move in the direction of inflation. Okay, and that's why it's said to be an asset class which preserves your money. It will not create wealth over a longer period of time. Equity has the potential to create wealth provided you give long term 7, 10, 15, 20, 30 years. That's how you create wealth.
Yes, yes. I think we can take up questions from the audiences. One question they're asking is, what is expense ratio and how to calculate that? You mentioned that expense ratio is usually high for active funds and it is lesser for passive funds. Maybe is it because passive funds require less effort from the fund manager's point of view? They just have to replicate the index funds and
Yes. So
do have to.
It's very simple. Okay, what is passive? You go to Google, write Nifty 50, you'll get those 50 stocks. You just cut, copy, paste those 50 stocks. That's called passive investing. Okay, but obviously it sounds very simple, but there's a method in terms of how you copy also.
There's a weightage for each and every stock.
And you build a portfolio on that. They are passive funds. Since there is no research involved in selecting those stocks and you're just doing a cut, copy, paste, the expense ratio of these funds are very low. Okay, these are called passive funds. In an active fund, there is a fund manager, there is a team of analysts. Their job is to basically research all the stocks, try to find out good stocks which are undervalued, the companies are good, the balance sheets are good, and their endeavor is to beat the benchmark over a period of time. So obviously, since they are adding value and then they are doing research, they will charge a fees for that. And that's the reason why in active funds, you have a slightly higher expense ratio. In a passive, the expense ratio is very low. Okay, what is expense ratio? It's basically a fees which a mutual fund charges practically every year. Obviously, it's calculated on a daily basis and it's charged also on a daily basis. Just to give you an example, every fund on a fact sheet, the expense ratio is mentioned. Just to give you an example, let's say, as an example, the expense ratio is 1.2%, or let's say 1% to make it very simple. So daily, the expense ratio is charged 1% divided by 365 days. Whatever amount comes, which is a very small decimal, it basically gets charged on a daily basis. So it's basically a recurring fees, but it goes into decimals because it's like whatever expense you can see, it's an annual expense. But you know what? That's the beauty of mutual fund. It's called economic of scale. A fund manager, an amazing fund manager, an amazing team of people with amazing risk management are not just managing money only for you. They are managing money for thousands, lakhs, and crores of investors. It's like an IPL match. Okay, technically, those players are not just playing for you; they're playing for a lot of people. But the cost or the expense of one ticket is very low. Same with the movie. Okay, the movie which might be made for 200 crores, the cost for a movie ticket for you is only 200 bucks. So you're getting amazing research, amazing fund managers, amazing track record at a very fraction of a cost. And the beauty is that it doesn't matter whether you invest 5,000 or 5 lakh or 5 crore. The portfolio for everyone remains exactly the same. That's the beauty of a fund manager and the beauty of mutual funds. Yes, there is expense ratio, but the beauty is that it's absolutely justifying for the value which they provide on table.
So is it significant to the fund's performance also, sir? I mean, if a good fund manager who has got, a very good track record in managing funds, obviously he'll be, I think he'll be charging more compared to the other fund managers. No. So how does it work that way? Is it a normalized same thing for all the fund managers? Sir?
Sounds good. Perfect. See, there is an expense ratio which is defined by SEBI. Okay, SEBI is a governing body. Securities Exchange Board of India is a governing body for all mutual funds. They have basically built the expense ratio formula for all mutual funds which we can charge. And all mutual funds are very well regulated, very transparent. We show our NAVs on a daily basis. We show our portfolio on a monthly basis. Absolute transparent portfolio. Okay, the expense ratio is basically charged on a daily basis. Now whether the fund is doing good, whether the markets are going down. So you might ask a question: if market is going down, okay, and if stocks are falling, will you charge less? Or if markets are going up, will you charge more? Whether the market is going down, whether the market is not giving returns, or whether the market is going up, mutual funds will charge a fees. That's first. Second is, if a fund manager for that period is not able to give good returns, the fees will still be the same. If the fund managers outperform the market, the fees will still be the same. Now, the endeavor for every mutual fund, because we are in the business of generating alpha. Alpha means basically outperforming the market. The endeavor of all the fund managers will be to try their level best as a team to create outperformance over a period of time. So obviously, if we do well, we get more assets, we do very well, and that's what we are into. There is an incentive for us to do well, to do amazing research, because the more value we add for the customers, the more assets people trust with us, and they give us those hard-earned money to manage the money.
Okay, thank you, sir. And the next question would be, one of our audience has asked, what are some red flags to look out for by investing and disinvesting in the market? So how do we time the investment? So do we look for the downturn in the market, or it doesn't have any significance at all? I mean, we just go out whenever we have money and start the SIPs.
Okay. See, you know what? In life, a lot of things are simple, but we love to complicate it. Okay. Never look at success stories. Okay. In fact, I have a different view. We always look at success stories, always look at failures. Okay. Always look at how things can go wrong. Never look at how things can be right. Because if you try to protect all the things which can go wrong, you will succeed. Okay. I'll give you an example. My friend just texted me half an hour before the session got started. He said, Amit, there is a multi-level marketing scheme. Should I invest that money? Within a fraction of a second, I said him no. Because you know what? By nature, everybody wants to make money very fast. Okay. And that's the reason, if you remember, in the last IPL, we had all crypto ads which were coming. Okay. Everybody saying, how can you double your money? Everybody wants to become rich overnight. I'm sure if somebody told me that, you know what, in the exam, these questions will come in and you will come first in class, most likely you might also get very tempted. The idea is there is nothing called as easy money. Okay. And you know what, you might also get a lot of calls saying that invest into this stock and the money might double, or you might invest into these penny stocks, your money will double, this, that. Don't do any of it. I'll tell you big money mistakes what people do. The first big money mistake is that technically people don't do goal-based planning. If you have short-term goals, put that money into safe. If you have long-term goals, you can put more into equity. That's first. Second is take risk based on your risk appetite. Okay. There are a lot of people who take excess risk because their friends are taking, neighbors are taking. Don't do it. You have unique goals. Take risk based on your risk appetite. Second. Third is emotions play a very big role. See, when markets are going up, I'll give you a very simple example. You must have seen a trend. A few SIPs, a lot of people are now actually starting to maybe stop their SIPs or contemplating, should I stop my SIP or not? And you know the reason is why? Because last 1-2 years, the SIP returns have not been great. So if the returns are good, everybody says mutual fund sahi hai, mutual fund sahi hai. And when market is not doing well, everybody says no, mutual fund sahi nahi hai. Mutual fund was always sahi. Mutual fund sahi tha, sahi hai, sahi rahega. Markets will go through periods of ups and downs, okay, which is very natural. In life, you get nothing free, okay? If equity market is giving you good returns, the journey is not a straight line. There's a price for it. The price is ups and downs, which is called as volatility. You have to understand that. And that's why it is also about psychology. You have to be patient. In good times, you have to manage your fear. You have to manage your greed. And during markets falling, you have to manage your fear. If you can manage your greed and you can manage your fear, and you can also manage your boredom, because there will be periods when market is giving no returns and you might get completely frustrated. Oh God, man, 3 years, no returns. I would have rather put money in fixed deposit, this, that, this, that. You have to just understand that's all part of the cycle. Ups, downs, everything is part of cycle. You're investing this for 20 years, 15 years. Why are you getting bothered of what is happening in the market? So if in case you can manage your emotions very well, I can vouch you will make amazing returns. But if you try to outsmart or try to be over smart or try to be overconfident, you will make mistakes. If you say, you know what, I want to just buy in random stocks. Okay, I will time the market. I will do this. I will do that. I'm very sure you will not make money, but these are recipes for destroying money. My simple, humble submission is don't do all of these things.
And there is also overload. I mean, in today's world, there is overload of information about everything, sir. How do we, come out of that? So how do I get to know which fund? What are the parameters? If there are set of parameters which I have to check before investing in a particular mutual fund, because we know, right? So there are like literally n number of mutual funds, and every day new funds are also, getting incubated into the market.
Sounds
so
good.
for a beginner, how should he, narrow down on this approach?
Sounds perfect. So Vikram, if you remember, I started my presentation by telling you what is the biggest challenge that you guys face. It's called a paradox of choice. Okay. Yeah. Yes. Whether it's getting married for you guys, it's going to be very difficult because you have so many options, right? From buying a mobile phone to watching a movie. Okay. Earlier, I remember when I used to go and watch a movie in a theater, there will be few options. I had an amazing time. But when I watch it on Netflix, half of my time goes into selecting a right movie. And that's a paradox of choice. Today, there are so many mutual funds, so many options, and 24/7 information. Earlier, there was only one Doordarshan with 20 minutes of information. Today, there are 500 news channels, and anybody who has a mobile phone, okay, can start a news channel and start you with information. And there are tons of advice out over there. The idea is you have to keep it simple, okay, because the power is in simplicity. The power is not in basically making things complex. Okay, the session's name was perfect strategy. Actually, there's no perfect strategy. There's no efficient strategy. There's no best mutual fund. You have to become a best investor rather than finding a best mutual fund. Like I told you, I'll give you an example of HDFC Flexi Cap Fund. Okay, in 28 years, we have generated. I told you how the NAV moved from 10 to more than 1,100 times. Okay, it made amazing returns. Even a 1,000 rupees SIP. Okay, I don't know the exact amount, but approximately it's more than 1 CR or 1,000 rupee SIP in these 28, 29 years. But the interesting point is, you know what? When you look at the journey of the fund, it doesn't mean that this fund would have done well every year. Yes, first of all, the fund had a lot of volatility. Like there was a dot-com bubble, which was in 2000. The fund corrected a lot. During 2004, there was election uncertainty. The fund corrected. During the time of 2008 global financial crisis, this fund corrected. Then there was basically a period of 2011, 12, 13, 14, but there's a lot of volatility in the market because a lot of uncertainty which was there in the country in terms of reforms, not great reforms happening, corruption and all those things, high inflation, a lot of uncertainty in the fund. So if you look at the entire journey, the fund went through a lot of ups and downs. Second thing, what happened? This fund didn't outperform the market every year. There were many years the fund actually underperformed the market, but there were many years the fund did outperform the market. You have to understand that it is not that the fund will outperform the market every year. Okay, there is no fund in the world which will outperform the market every year. Every fund will go through periods of underperformance. It's like IPL. Okay, not every player will play extremely well every year. You have to select those AMCs which you trust. There are many asset management companies whom you trust, who have an amazing reputation, who have been there for decades, who have got fund managers who have an amazing solid track record, funds which have an amazing solid track record. So my simple submission is that don't select fund on last 1 year performance. Look at the long-term track record of the funds, of the fund managers, how the funds have done in various cycles, how the fund managers have managed it, what is the team behind it, and are those AMCs, is the mutual fund asset management, is it their core business? If in case those answers you are able to answer it, then you will be able to bring down to 3 or 4 good asset management companies. Okay, and I would not say do your own research because it's your hard-earned money. Do your own research. I belong to HDFC, so obviously I'll say put in HDFC. But the answer is very simple: do your own research. Okay, that much research you'll have to do. And as a starting point, I would say if you're putting into equity, a flexi cap fund is a very good option. If you want to start passive funds, then a Nifty fund is a very good option. So Nifty is basically just investing into top 50 companies. A flexi cap is an actively managed fund, is large cap, mid cap, and small cap. You have got all the 3 ideas. Maybe you can use flexi cap or a Nifty, or maybe have a combination of both. Whatever you feel right, you can do it. For your short-term goals, put money into an ultra short-term fund. Okay. For your vacations, for your emergency, for your short-term needs, put this money into ultra short-term fund. You can redeem that money whenever you feel like, and you can achieve your short-term goals.
Thank you, sir. I mean, we have reached I have the last question to ask you now. The last one is, so what will happen if I miss any particular SIP? I don't pay for whatever reason, maybe. So will it affect my overall investment?
Nothing will happen. It's not like a bank. It's not like a bank EMI where you miss your EMI and your banks will start calling you. Because if you don't pay it, then there's a problem. No, it's your money. For some reason, okay. Let's say if you just happen to overspend that particular month, okay, that month SIP will not go. Or maybe if in case you realize there's some challenge in life, or maybe you're going for a vacation and 2-3 months you cannot do an SIP, just pause your SIP, okay, and again you can start your SIP. Nothing will happen. That's the beauty of mutual funds. That but be disciplined. These options are available, but please don't execute these options. Try to maintain discipline. Even if it's a small SIP, start. There's no amount which is small. Start with 2,000, start with 1,000, then increase to 5,000, then 10,000. And trust me, most of the participants, there will be a time when you will do SIPs for 1 lakh rupee. Then you might even do SIPs for 5 lakh rupee. You might be laughing at this thought, but trust me, as your incomes would increase over a period of time, your SIP amounts will increase. And SIPs and lump sums are a best amazing way to create good corpus for yourself and to achieve all your financial goals and have an amazing life.
Okay. Thank you, sir. Thank you for your time and giving those wonderful insights about the mutual fund. I'm sure most of our viewers who are just beginning to invest, they got to know about the mutual fund market, how to approach, what should be the strategy, so that they don't lose out on much on the mutual fund. The basic, I mean, to summarize it, so the need for investing is to beat the inflation. The idea is to do your own research and do check for the history of the performance of the fund and the fund managers, how they have been managing it over the years, and go about investing. Thank you, sir. Thank you. I'm sure most of our viewers will benefit from this session, and thank you for giving us your valuable time.
Thank you, Vikram, and thanks the entire team for giving HDFC Mutual Fund an opportunity to talk to your clients. Thank you.
Thank you, sir. Thank you.
Happy investing. Bye.
Thank you very much, sir.